Want to start or scale your property development business to 8 figures and beyond, then you're in the right place. This is the Property XPerts Podcast with Ben Richards and Jack Diggins, two serial entrepreneurs bringing weekly insights from our award-winning businesses. In these podcasts, you'll learn how we found, funded and delivered over £80 million worth of property in the last 6 years, with templates you can use, deal analysis and deep dive discussions that will help you build your businesses successfully. We hope you'll enjoy. Hello.
We've got a special episode today on the autumn budget. Obviously, news came out yesterday, so we're super excited to be going into the detail on how that's going to impact the UK economy, property investors, people like us, our listeners, and we'll be sharing our views in the episode. If you haven't joined us before, we see ourselves as business owners, but have been called serial entrepreneurs. We've set up relative businesses that all integrate together in property construction and service-based businesses too. Our goal in our development company is to deliver 1,000 homes, which will be hopefully £1 billion worth of property if Rachel Reeves lets us. And we're known to be ambitious. Hopefully from this channel, you can see we're transparent and creative. We've actually got some topics later on creativity too. The way that we grow our main development company is we partner with investors that are interested in getting involved in property at any stage. Just this week, we're closing off an investment with an investor who's started off quite small, but has grown with us and done multiple investments once we've collaboratively grown. So if you are interested, we basically kind of always have something that's worth looking at or considering. But the first stage is you reach out. We have a very candid chat with you. We even, in some of those chats, understand the requirement of investors and whether we're the right partnership. And then we take it from there and start looking at some deals. So if you are interested, please do reach out and we'd love a chat. So today's agenda for podcast listeners, it's 28th of November. Which is the day after the autumn budget, which I feel like we've been waiting about 12 months for it. And we're going to be going straight into that and talking through the budget breakdown, what it means, what our opinions are of those budget changes. Obviously, we've gone from a pretty poorly managed Conservative government into a Labour government. So most of our listeners on this are business owners, people that are trying to grow, people that it really does hurt being in a Labour turn. We have a few followers that might not have that view, and maybe some haters and people that think that we're greedy business owners. But we're going to be sharing our views and going through sort of line by line the main changes and what we think that means. And of course, we'd welcome questions. So please do ask your questions all the way through. Section number 2 is property legals. We used to be able to do a HMO within like 8 months. That's now physically impossible, and we've had some refinances take 8 months. So I've got a tip to help nurse that along in the right direction for speed. We're going to be talking about 2 development opportunities that have come from TikTok.
TikTok.
Even though we're quite young, Ben, I still feel a lot too old for the TikTok. We're going to be talking about deal creativity. One of our mentees actually asked us, they said they've looked at 300 deals this year and haven't had any success. And what is the key to getting that success dialed down? We'll be talking about development mix. So obviously in a development, you might want 1, 2, 3 beds, a different blend of houses, how that impacts your gross development value, and being strategic with design measures. With the final point, which is going to be an easy solution to reduce busyness. Now, this actually came back off the review of one of our team members and some advices that we were sort of trying to enable them to not be spread too thin. I mean, sometimes it's inevitable when you're running the businesses like ours with family life and business, but that's some tips to help improve it. And then we'll always be going into Q&A. We've got some pre-prep questions that we didn't have time for last week. And please do ask questions all the way through, because we will answer them. And it doesn't cost you anything to ask the question. And we'll get round to them. How are we doing, Ben?
We got some good questions at the end of this from various different platforms. So Thanks to everyone that has asked them. Like Jack says, it's free to ask. So get your comments in now. And whether it's this week's episode or next week's episode, we will come round to it. So yeah, get your comments in. So the budget. We've been waiting for a long time for this. I think people have been sitting on their hands and doing nothing, which is like the opposite of what this country needs. And, you know, the headlines are a mix, and we're going to go into some details around what they have done, what they haven't done that maybe we think they should have done. But just reading some of these headlines, you know, despite weeks of speculation, the Chancellor's speech contained no changes to stamp duty. Disappointing, no announcement on LHA rate increases, which remain frozen. However, Rachel Reeves has pushed ahead with plans for a mansion tax on properties worth over £2 million, an increase in property income tax, and increases to the national minimum wage. So let's jump into it. You know, there's obviously a lot of a lot of comments all across social media from various people with their views. I'd love to know what your views are down in the comments as well. So make sure you get those in. So what have they done? They've taxed more. You know, it's unusual, not unusual for a Labour government to be looking at taxing the hell out of people. And they've certainly done that. And I think the first point that I wanted to come on to, which is the stealthy one, that the comments that I see now on like BBC News today is like, have they gone back against their manifesto, blah, blah, blah. You know, they haven't increased tax rates per se. What they have done is extend the income tax band freeze. And this is, I think, the sort of sneaky one whereby, you know, it's not, the rates haven't increased. People don't see that as the headline. But a lot of people, including my wife, doesn't really understand the impact of this until it's explained. And the reality is that as inflation, you know, rises, as wage growth increases, for example, you get a increase in your wages in work, you get a pay rise, you get bonuses, etc. What happens with a tax bracket freeze is that your new pay takes you into that next tax bracket, and therefore you're paying more tax because of that delta. And that's the stealthy one where, you know, flat out they're not saying there is a tax rate increase, for example, which is quite obviously a tax rise. These income tax bands being frozen, I think, is more of like a stealth tax that some people won't even clock as being them paying more tax and therefore taking less home after all said and done. So I think, you know, it's going to impact everyone. I think from what I've actually read, this one in particular and some of the other ones that we'll come on to don't actually come into force until 2028. So actually, you know, there is still some pathway. You know, I guess 2028 is the 4-year term for the government. So will they even be in place in that time for this to really take effect? So although it's, you know, a blow for everyone as such, it doesn't come in for another 3 years, well, 2.5 years. And, you know, a lot can change in that time. We've got two. I mean, this is the one I think that will impact, obviously, everyone tuning into this. Most people tuning into this will be business owners. They will be property investors, property developers. And there is a 2% tax hike on that income. So if you've got rental income in your personal name, you know, you are now paying 22% as a basic rate taxpayer. You're paying 42% as a higher rate taxpayer. And unless you've been living under a rock for the last sort of 5 years, most people, to kind of counteract this type of thing, as well as the Section 24 taxes that were brought in back in 2018 maybe, you know, you probably would have incorporated or moved your properties from your personal name into a corporate structure where you're paying only corporation tax, and this tax hike doesn't really affect you. But there will be plenty of people, you know, the accidental landlords that make up the majority of the rental space, i.e., you know, most landlords actually only have one property. You know, they've bought a flat, they've moved into a house with their now wife and partner, and they've kept the old one as a rental property to get some extra income, to you know, look at the future in terms of building their own pension pot with that property. You know, that is very wide and very common, and actually it doesn't make sense to incorporate, for the most part. Again, this is not tax advice, but it doesn't make sense for people to incorporate when they've just got one property. I've still got one property that's in my personal name, and I'm just kind of dealing with it. So this tax hike, albeit it will affect some people, most people that are genuinely kind of long-term property investors with a larger portfolio aren't going to be impacted as much. The one thing that probably everyone listening to this will be impacted by is the dividend rate increase. So that dividend rate at the lower rate will be going from 8.5% up to 10.5%. And 10.75%, and the upper level will go up to 35.75%. So most people, probably like we do, will structure a basic salary of £10,000 to £11,000. We will then draw dividends up to basically the sort of £52,000 bracket, and keep ourselves within that basic rate tax threshold. But even at that point now, and when you look at it as a percentage, effectively it is a 25% increase. So going from 8.5 to 8.75 to 10.75, is basically a 25% increase in tax payable. So although 2% doesn't seem a huge amount, the actual impact on that lower rate threshold is a 25% increase. So, Jack, any thoughts on that one?
Yeah, I mean, on the property tax, so to put it in perspective, Ben's already mentioned the sort of huge volume of people that are in the, landlordship space that own one or two assets. This is the governments, plural, have been hammering personally owned landlords. And to put it in perspective, there's around 200,000 rental properties that are now being sold back into the market per year. So to put that in perspective, we're not delivering as a new build anywhere near as many as those. So it's a lot of volume that's being sold back into the market. So I kind of feel that's just chipping away at an already moving trend. And realistically, I think that actual additional taxation is not necessarily the whole point that the budget is brought in place from the Labour government is to raise money. I don't think that's going to have a positive impact, net positive impact on that actual tax figure there. Yes, they'll gain fees in stamp duty and land tax with property transactions. Yes, that might spur some more bottom of the ladder ownership, which we're all for. But I think the net value result of that will be negative as a knock-on effect. And same with dividends. I don't think it's going to bring him in more tax. I think the directors just pay himself £5,000 less, and they're paying the same amount of tax as they were. So the actual value being generated there, and obviously we've already seen the most business ownership and entrepreneurialism leave the country. I don't think we should be encouraging dividend tax, especially when it's if someone's paying themselves 50 grand a year to take all the risk and run a business, why should they be hammered more when they're providing employment, sub-economies, creating goods, building into the supply chain, investing in the UK, paying tax in the UK, under corporate structure, not personal structure? I don't think that they're targeting the right things. Where this is, and the general vibe that I got from this budget is they're winning votes. They're appearing like they're taking from the rich and giving to the poor and leveling the playing field. The actual reality and the ergonomics of what they're doing, I think, is actually making it harder for the for the people that aren't the business owners. An analogy I used months ago when Labour came in is if you went to dinner with 10 friends and you split the bill according to people's net wealth, and some people are getting away with, let's say the bill's 100 quid and they're paying a tenner, and the wealthier people are paying significantly more, paying £1, and the significantly wealthy people are paying £70. Eventually that person leaves, which is then makes it more expensive for everyone else. So I think it's a very short-term view on and winning is winning the vote of the public, saying, the rich we'll prevent the rich from keeping getting richer, but you forget about the supply chain that rich is providing, rich in inverted commas, because I think that could be a very loosey term. And also it's a bit different if you're sat on a big portfolio, you're a baby boomer, and you're just sort of hunkering capital and living off the steam, and as opposed to growing, and this impacts growing businesses, as well as the increasing, which I'm sure we'll come on to, minimum wage. Again, that's punishing growing businesses. So yeah, that's my general view.
Nice. It's worth saying that these changes do come into effect in April next year. So this isn't one of the ones where, like the freezing the tax bands, it doesn't come in for 3 years. This is active in 4 months' time. So yeah, get your tax planning in now, and speak to your accountant to understand how you can potentially bring some things forward into this tax year. And it's 2%. On the grand scheme of things isn't massive, but like I say, it's effectively a 25% plus increase in tax. We've got the mansion tax, which, to be honest, it's not going to affect that many of us. You're talking central London, like super high high value areas of London. They're going to fit into this £2 million homes. I mean, I honestly don't think there will be people that live in £2 million homes that have just been very, very lucky in terms of how house prices have increased over the last 40 years. They're baby boomers that have a lot of equity but don't have a lot of cash to be paying. Effectively, is it £7,500 or £2,500 for a £2 million house, and then it ramps up to £5,000, then £7,500 as a yearly tax. Now, my understanding is this is meant to be sort of like an additional sort of council tax effectively. But council tax, when you look at and break it down to what council tax is, it's to provide services to waste, to the roads, to filling potholes,
fire engines, police.
Yeah, fire engines, police, all that stuff. The value of your home is irrelevant to those services. So it's basically, again, targeting the public, making it to be seen that they're taxing the rich and giving back to the poor and all this sort of stuff. But I think fundamentally that's all it is, really. I don't think it's going to generate a huge amount of revenue for the government. I think it's going to continue to stifle an already stifled London market, which has a massive economic impact outside of this. If there's movement in London, that often ripples out, and people want to invest into London, and we've become a capital city that has nowhere near the drive or the appeal to outside investment anymore with the nom-dom changes, and now these mansion taxes. It's going to start putting some sort of downward pressure on the values at that level, and the sort of sales brackets in terms of going over that level. It's going to stagnate that type of market. But
I mean,
only a small number of landlords will be affected, really.
I think most persons that own so the threshold is 2 million, and then it hikes up again for 5 million. I think the relative cost increase isn't really going to bother them or feel like it's any different. I do think it's going to impact people that are inheriting assets, so that asset rich and cash poor, because it's an additional cost to come to maintain, own, and I think that end of the market's going to struggle. If I'm honest, I think it already kind of does. I actually, again, I think this is more of a sales tactic, of like, people that live in big houses, you got to pay more. But what does that actually mean? So I actually looked at some stats on this. So day one, just purely on the threshold for £2 million houses in London, should reap about £10 million additional income per year in London, just using London as an example. And then you look at all of the requirements of what it costs to run London. To give you an example, the government allocate about £25 million per year just to fill potholes in London. Mm-hmm. So then when you look at everything else, it's not really doing a lot. It's not really, it costs something like £6 million to rewire and put the new lighting on Tower Bridge, London Bridge. Like when you look at all of these costs that it costs per year to maintain and service London, that cost isn't really going to touch the side. So great, it makes the world feel better about, you know, me not living, and it kind of amplifies it that it's called mansion tax, because if it was called something else like additional contributions council tax, there wouldn't feel like there would be a national win between the classes or the value classes. Mm-hmm. So I think it's strategic and a load of nonsense and masquerading not a lot really.
Yeah, I mean, one of our clients is buying a house in Knightsbridge, and you know they're spending something like £2.4 million on it. It's 94 square meters. Like, it's not a mansion. It is a 3-story townhouse. It just happens to be in a very, very affluent, obviously, area of London. So it's that's marketing spin at its best, isn't it? You know, calling it a mansion tax. You know, we're taxing all of these wealthy homeowners, blah blah blah. Anyway, on to the next one. For those that are in service accommodation and short-term accommodation, short-term lets, the government are looking to bring in a levy on Airbnbs, effectively a tourist tax, which doesn't really affect us. You know, we don't generally do much service accommodation. We know a lot of people that do. And I actually don't know if this one is. I don't know when this one comes in. So I can't advise on that really, but I don't know whether that's like a 2025 thing or let me have a look. Airbnb levy.
Yeah, I mean, it's one of those. It's great for the public of the UK because we're now topping up the taxation pot with international money. But there's also a counterintuitive argument. Is it going to make it too much more expensive? I think it's going to work out to be £1 or £2 per night per property. Is that going to deter people pushing England into a more expensive place to visit and be a tourist? And then how much of that tourism do we rely on for income? I don't think it's huge detrimental change. I mean, it'd be interesting to see how they police that and manage that. Because it's quite fiddly to make £1 a night on an Airbnb is quite a fiddly way of earnings, but
I don't know when that's coming in, to be honest, but like you say, I don't think it's really going to impact things a huge amount. This one, to be honest, the EV car tax, the pay per mile charges, it's 3p per mile for EV cars and 1.5p for hybrids. For me, like this was always on the cards as far as I'm concerned. You know, they've given loads of incentives for businesses, for people to transfer over to EV driving. You know, they're constantly looking to decarbonize the electricity grid and roll out better charging stations in locations. You know, the benefit in kind for driving an EV car in a business 2 years ago was 0%, and it's gone up to 1%, then it's 2%, and it's nowhere near the levels of driving a petrol car. So to be honest, I think if you didn't expect something like this to come in, where EV car drivers start to get taxed over time, I think you're probably a bit naive. I do think this is something that was inevitable. It will continue to go up. You know, at some point they'll probably want, let's say 10 years ago, where driving petrol cars were in terms of road tax and levies and things, they're going to want that same to happen, but they need to have this transition for people to move into the EV space, which is where the government want to push things. So I don't know what your thoughts are on that.
Yeah, I own, own 2 electric cars. Don't have a problem with actually taxing EV. I think it should have just been a road tax, if I'm honest. Because that's how I feel. I do quite think the per mile is quite smart, and actually, if that could be a good translation into combustion cars, because then you're actually, my nan who does 600 miles a year probably shouldn't pay the same road tax as someone that does 60,000 miles a year. you're just relative, then it gets slightly difficult, because actually that then becomes really costly for 60,000 a year of travel, and typically that will be for business and then a business expense. So
I mean, that's a huge amount of miles.
How do you gauge that? But I think it's fair, and I actually welcome it, because that's one of the reasons, back to potholes. I believe potholes are so bad at the moment because like EV cars has grown like 100% year on year for the last 6 years with zero road tax. So there's a big hole that should have been dealt with sooner.
And EV cars are about double the weight of a standard petrol vehicle because the battery's so heavy.
It shouldn't be done on weight.
Heavier.
I mean,
yeah, but if you imagine
on a flight,
the wear and tear on a road is going to be more with a heavier vehicle than it isn't.
Same with an international flight.
Why does that matter?
Or if you weigh double, more fuel, more,
you're probably using more fuel.
Yeah.
But that's different kettle of fish. But I mean, looking at it from a purely financial perspective, 10,000 miles, let's say on average, at 3p a mile, you're talking 300 quid a year, which in the grand scheme of things, when you generally do drive an EV car at the moment, it is super cheap to do so, especially if you're leasing it through a company or doing it that way. So yeah, I don't really see that being a massive deal. And then tax on pension contributions. So this is another one that won't come in until 2028. Is I mean, I guess I don't fully understand this at the moment. It's not something that massively impacts us, for me in the way that my kind of future is set up. At the moment, property is my pension pot. I've got small pensions here and there, and I make some contributions from a tax perspective, but I don't feel like this is going to impact me a huge amount. I don't know about you.
Yeah, again, I think the typical people putting into pensions are business owners between the age of probably 45 and 65. I think we're a little bit under that age bracket. We're obviously building a pension with portfolios, so not too much to add on the pension front from my end either.
Yeah, so it's basically from 2029, this is as well, the amount that is exempt from national insurance contributions will be capped at £2,000 a year for employee contributions made via salary sacrifice. So actually it's a small portion of what people do anyway from a salary sacrifice scheme. Salary sacrifice is when you agree to reduce your gross salary or sacrifice a bonus, and in return your employer pays the same amount into your pension. So there's an element of that having a knock-on effect with business owners as well, if they're the ones that are effectively kind of making some of that contribution. I don't see it being huge. So I'll say that's the sort of key things that have come out of there's other things like the release of the two childcare benefit cap or two child benefit cap. So I think that's obviously very heavy on the welfare state side of things. Doesn't is it the right thing to do? Probably not. I don't have a massive opinion on it. Will it mean that some of the public see that as free money and they'll just shag away and have loads of kids because they'll get 300 quid a month in extra income from benefits because of it? I don't know. I don't think it really impacts us a huge amount. But those are the key things that they've done. So I think the one thing that I wanted to touch on is what they haven't done, which I think is more telling than what they have actually done, in my opinion. I don't really think they've done anything to stimulate growth and investment into the UK. I think they've, to a certain degree, been living under a rock, and I don't think truly understand what is going on out there. Unemployment is at its highest. It's harder than ever, I think, to be a business owner, and business owners, entrepreneurs like us, stimulate the economy, grow the economy, provide jobs, invest, innovate, and nothing that they released this week has done anything, in my opinion, to grow that or tackle that, which is which is a massive shame.
Yeah, I'd say the only thing that they have done is the support for apprenticeships in SME businesses.
Oh, that is something I missed off that list, actually. Yeah, that is pretty decent.
Yeah, but I mean, it's
probably doesn't scratch the surface though, right?
Yeah.
From a purely property perspective, no changes to SDLT. There was all sorts of conversations around potentially pushing SDLT onto the seller rather than the buyer. There's obviously like transitions and stuff that we need to happen in that. No changes to how that operates, which again is a shame because the housing market is dead. There's literally zero movement. The sales rates are ridiculous. We're seeing that firsthand on a lot of our projects where things are taking 12 months instead of 6 to shift. And that obviously has a massive impact on us and our ability to then take more profit into the next scheme and grow and invest in the next project. So yeah, I think SDLT is a missing piece.
Can I just touch on that as well while we're on it about stimulating market growth? They also haven't addressed, this Labour government is supposed to be supporting people that don't have the privileges that others do and taxing the rich and helping areas of the market that feel less fortunate, but they haven't done anything with affordability or mortgage support, which again is really imperative for, well done. Let's try and hit 1.5 million homes delivered. Who's going to buy them? You're not offering any support and it's going to be too late by the time that they're not going to get delivered. We all know that. But by the time they're delivered, you can't then retrospectively incentivize the market. The confidence needs to come from now. And that inversely helps enterprises like us. So it's a sort of two-way win there. And actually, I have a bigger problem with that because the affordability in this country is ridiculous. People can be paying £2,000 per month rent for 5 years, but can't pay £1,600 for a mortgage because they can't get the approval for it. They've proven that they can afford that. So there needs to be more stimulus in that market space as well, I think.
Yeah, agreed. This impacts us a lot because we have built the social housing portfolio in South London that we've been building over the last 5 years. The LHA rates were frozen this year, and they are going to be frozen again in 2026. They went up in 2024, but that was because they were frozen for 3 years previous to that. So over the last 5 or 6 years, 4 or 5 of those years have had no increase in the LHA rate whatsoever. Ultimately, that's widening the gap. When you look at the market rent for these things, the market rent could well be now 35-40% more than the LHA rate. So ultimately, you've got a bigger gap between actual rents and what lower income tenants can claim. Similar to Jack's point, increasing pressure on that affordability and widening that gap. And it's woefully lower than where it needs to be. Even the increase in 2024, we were actually anticipating 20-25% increase. In our area, it went up 8.6%, which is nowhere near close to the delta that it's meant to be in terms of where the market rate is versus the LHA local housing allowance rate. So they haven't made any noises around LHA and supporting that sort of welfare state. They also haven't done anything to help construction industry get moving. If you're talking about labor, if you're talking about construction, labouring, apprenticeships coming in from the bottom, the apprenticeship scheme, might help that front. But they've also increased the living wage and the national minimum wage for sort of 18 to 20-year-olds and above that. So you've got basically unemployment rate at its highest. The cost of employing people at that, even at that lower end, is now higher than it's ever been. So somebody's got to find a job first to be paid that national minimum wage, and that is extremely challenging. My wife's just been through that, where it's taken 3 months to she's very experienced in her position, lots of very employable, yet there's nothing out there. And it's very, very difficult. So from a construction industry perspective, I really don't think that they've done anything to stimulate that. The construction industry is a massive proportion of the UK economy, like massive. I think the last figures I saw was something like 40% of the economy is driven by the construction industry. And if that's not growing, that is has a huge impact on the nation as a whole. So literally nothing whatsoever, I think, to get that moving in the right direction that it needs to. They've been talking about the planning process and building 1.5 million. We're on the ground with this. I've seen nothing, no movement other than negative movement, things getting delayed even longer, policy changes, more red tape. Nothing is moving fast. Yet they want to build 1.5 million homes in the next 4 years. It's ludicrous.
Yeah, completely agreed. They are actually impacting the construction industry. They're doing some reforms to tighten anti-fraud rules and simplify admin for CIS to boost compliance. So
brilliant. Yeah.
That's
so they can get more money and make sure people are doing the CIS process properly, I imagine, more than stimulating anything. I mean, the CIS process, in my opinion on that, is that it is a very heavy admin burden, especially for the type of people that fall into that CIS regime, which is often SME builders that it's Barry and his gang of mates. And for them, even getting invoices out the door is often done by the missus, or done in the evening or a weekend, because they don't have the time to run the admin process. So yeah, that doesn't feel like much positive impact to me. Nothing to help the unemployment rates, like I've mentioned. They've increased the minimum wage, but ultimately, that's not going to help the high. We are at the highest unemployment rate that we have been for the last, I think it's 12 years, which just is not a good place for the UK economy to be. So the apprenticeship side of stuff, we'll see how that plays out, but I don't think they've done anything really to help improve that unemployment rate. There was a lot of talk about them putting national insurance on rental income. They haven't done that, which is a positive thing for us, ultimately. But I guess the 2% hike on the property income is, I don't actually know what's worse. I haven't run any financial sort of calculations, but I imagine actually this 2% hike is probably worse.
Yeah, I mean, she actually in the actual pitch, she did sort of say that the tax structure is not the same to if you're earning X amount and if you're earning X amount from rent. So I think that's kind of like a relative exchange of how she positioned it. Basically saying, I'm doing this because of also I acknowledge the national insurance on rental income. So one thing we haven't touched on that they did do from a property perspective is rebalancing of business rates. So permanent relief for high street shops, pubs, offset by big warehouse and office changes.
I did see that. Yeah, the Amazons, make sure that they're paying the big giants. But your mum and pops have an easier ride, which is good, which is right. It should stimulate the high street, which is much needed to bring that back into play. If you caught last week's episode, I think it was either last week or the week before, there was a lot of chat around the high street with Class G of the permitted development rights that are available to you in terms of converting high street retail shops and uppers into a maximum of 2 flats above that retail unit. So if you haven't checked that out, that is one way that you can definitely pounce on these types of opportunities where converting retail space into residential flats and making use of the massive amounts of vacant properties on the high street can benefit you. Cool. I mean, that's pretty much where we're at. I think let us know down in the comments, whether you disagree, agree, what your points of view are. I'd love to hear from everyone in terms of how they think it's going to impact you individually, and what you would have liked to have seen, or what you might like to see from next year's budget. But until now, at least people might be willing to move forward and get off their hands now that they know actually what is going to happen.
I think confidence and knowledge of clarity. Great for the economy. Everyone knows what's going on, blah, blah, blah. Nothing is going to change is my general statement. Nothing. Like all of this means absolutely nothing to everyone. They're not going to raise more money. They haven't really been that heavy-handed, I don't believe, with various things. Our potholes might get repaired better. But I honestly feel that we're not going to make a dent in that requirement that they've pitched to make up the difference. And I'm amazed it took them this long to release this. I mean, they've just tightened a few screws.
Yeah. I think this is the big one. Nothing that they've done is going to stimulate the economy like it needs to. Everything is moving slower. Everything is just stuck. And that is no good for absolutely anyone in the whole pipeline of society. Cool. Talking about sort of legals and progressing things a lot faster. You've got some good tips on this, so fire away.
Yeah, so I'm not from a legal background. I find that since COVID and maybe before, but lawyers do tend to hide behind emails and be non-responsive and slow things down. And even though I can't bring a legal angle to anything per se, I often like to just do almost like a play-by-play to all of the lawyers involved. And we've discussed this before, where we've actually got all of the lawyers in transaction on a call and walked everyone through what's going on, and that was really useful. But this week I had to do it again, and I don't think we've shared this on our platform for well over a year, so I thought I'd sort of resurface it. But essentially we've got lenders, bank's lawyer, investors lawyer, our lawyer. That's actually it. There's no sales lawyer because it's a refinance. And we just weren't getting anywhere. And I was like, how difficult is this? We need like 3 documents done and agreed that we can just crack on. So I just said, correct me if I'm wrong. And this is kind of like how I like to position sentences with anyone. You know, if you're buying a site or if you're working with a lawyer, like you might be wrong, but you're trying to get progress. And I just sort of said, correct me if I'm wrong, but we need to do this. And then I put in bold who's responsible for doing those jobs, and then cast it out. And it kind of helps everyone go, oh, it's not actually a lot, or that doesn't. And some of them probably know it, others might not. But it's just being explicitly clear, like, you know, for avoidance of doubt is kind of like the sentiment behind just pushing this over to all the parties, CC'd in one email. Everyone's involved, everyone's exposed, everyone can see everything, everyone could comment if you are wrong, and you're just driving it forwards. And that urgency is sometimes really important with refinances. This one, our existing lender is getting really impatient and really wants, basically, I mean, and I can't blame them. I actually looked at dates, and this gives you an idea of what I said at the beginning of this live when I said things just take too long. We instructed the lawyer and the bank and the valuation in June, and we're now at the end of the year. So that's 7 months to do a freaking valuation, to do a freaking refinance. It's just, I could do a project back in the day that quickly.
Yeah.
You know, all said and done. So that was buy a site, renovate it, refinance it, 7 months. And this is the shizer we got to deal with.
Yeah.
That's it.
Nice. Cool. If you get value from these podcasts, whether you watch them on YouTube in visual or listen to them on Spotify or Apple, for example, please rate us. I saw that we'd breached over the 200 listens within the previous 7 days on Spotify earlier, which is the first time we've done that. Which is great. You know, that's where it needs to be. We want to continue building that and sharing value every week. And that's what we're here to do. So yeah, please don't forget to rate us, to click like, subscribe, comment, all that good stuff, because it helps share things wider. And we mentioned last week around kind of why we do these podcasts. You know, why would you in this day and age kind of put yourself out there on social media? You know, try to grow an audience, ultimately because attention is everything in this modern day, unfortunately, whether, you know, for wrong or for right. We started our TikTok account, I don't know, probably 18 months ago. And it's growing steadily. It's basically kind of repurposing and similar stuff across all of our social platforms. But everyone every now and again one pops off, does really well. But it's for reasons like this that we do that, and reasons like this that we do the podcast. As you would have heard last week by tuning into last week's episode, we do it to raise investment, we do it to raise fees for consultancy, and we do it for opportunities. And that's this week has been sort of proof in the pudding of that, where we've built a following on TikTok, like I say, and two people individually, both based in sort of Surrey area, have reached out via a DM and said, I've got a site. It's, like you see on the screen, it's 9 units in New Malden, £9 million GDV. Got another one in Godstone, Surrey for another 9 units, smaller GDV in that location. But ultimately, these are opportunities that other people might not have seen yet. And it's a good opportunity for us to be direct with these people. Both of the people that put these forward have control of the site, own the site, or have an option agreement on the site, which means it isn't sort of out there on the open market and being thrown around absolutely everywhere. So it works. This is why we do it. And hopefully, if you're tuning into this and you have opportunities yourself where you'd like to understand how we might be able to work together on a joint venture basis, or you're just looking to sell the site and want somebody that's active, buying a lot, does what they say they're going to do, then reach out to us.
Jim, our good friend, actually got one of his sites off Facebook.
There you go. It works.
Deal creativity. So was looking at a deal late last night with our acquisitions guy in XP, and also one of our interns come acquisitions guy in Central Suites. And the reason I wanted to share this is because I feel like there was almost like a bit of learning where I was prizing them to ask how we could structure things differently. It was a big block that I think could be maximized, almost like our St Helens Mill development. Take each unit to, renovate them, keep some rent roll on site. There's also some potential new build scope on the site. There's also potential splitting up the units or whatever it may be. So I was basically analyzing a deal, and analyzing a deal isn't just about, right, we buy it for X, we renovate the building and we sell it for Y, or we revalue at Y. There's so much more that can be adapted. So I sort of pushed it on them. I said, what else can we do with this site? And you could sell the garages, you could let the garages out and sell them. You could knock down the garages and build another block. You could knock down the whole block and build new units, and all that creativity is great. But then I look at things and go, right, and if you're watching on YouTube, you can actually see a pie chart that we have. I often, if I can't make a deal work, look at this and just try and think, what is costly here? You can see that the purchase price is a large chunk of the deal. You can see that the development cost is a large chunk of the deal. So you're looking at where the biggest spends are. What's making this deal not work? And if it's an income producing asset, it might be that your finance costs are really high because you're borrowing development facility on something that's kind of finished. And you can look at structure, you can look at deferred considerations, you can look at finance, you can look at, there's so many different ways that you can be flexible on the creativity of a site. And hopefully, if you've been following our channel, you've seen that on a lot of our deals, that's kind of how we make them work. Like they probably wouldn't work for just a vanilla buy, refurb, refinance, build and sell. There has to be that element of how can we creatively structure this? What could we do differently? And think to yourself the question, what have I not thought about, is quite important. And it was just to share that. Like, I love looking at just the high level figures. Think about why could this not be working? What could make this better? What could make it a bit more seamless? And just think more general, zoom out to zoom in is a really good method. And on that particular site, because it was a finished site, we could take rent roll all the way through. We could potentially look at a different funding pack, like a block buy to let product, and actually phase it over 2 years rather than taking a bridge to add significant value, try and get VP and then refinance. Could we string out the development to be a longer period of time? So there's so many things that you can actually think of from a creativity perspective. And try and pull that apart. And a really good way to do that is get a buddy, get a property developer or an architect that's a buddy, and sort of throw stuff at them and have a check-in, 30-minute check-in, and just run through things to see how you could potentially adapt, mold, structure the deal slightly differently and create value there, because that is where value is created.
Nice. Cool. So Jack and I are buying a new asset, a new office to resi conversion in Southwest London. And I've been doing a lot of work on the design recently. So I thought I would share some of my findings and learnings. And it's more about development mix. And I've mentioned this before, and this was a massive thing at the Berkeley Group, in terms of development mix being the development mix of 1 beds, 2 beds, 3 beds on the face of it. But then you go deeper and it's what location are those 2 beds? Are the 2 beds inwards facing to the courtyard, or are they outward facing to a railway line? That has a massive impact in the sales value of those units. So playing around with the development mix can have a massive impact on your gross development value. And that's sort of prominent and prudent in some of the sort of findings that I was working on with the plans on this. So our previous high level appraisal, when you're starting a project, you have to put a figure down. You'll probably speak to some agents and they'll say, well, in that area, I'd probably expect an average blend of £800 a square foot, for example. And that's what it is in this location. But that £800 a square foot is probably based on a blend of 2-bedroom flats. A 1-bed flat might go for something like £875 a square foot. Or if you got a large 2-bed, it might drop it down to £725, £750. So understanding this is crucial, because the difference between taking a blended average of £800 across the site and then actually drilling into the detail of the individual layouts, like I've got shown on the screen, can make a massive difference. And in this particular case, our blended base case scenario is £800 a square foot. But with the design that we've put in place on this, I think our blended square foot rate is something like £825 when you take into account the higher rate 1-beds versus the lower rate kind of larger units that don't warrant that higher pound per square foot price. So on this scheme, that's a 200 grand difference from us, just by a paperwork exercise, understanding your onions, thinking about it from a logical perspective, looking at the development mix and playing around with the layouts to suit. And in this scenario, one of my original schemes had 4 2-beds at the front of the site in this part of the portion of the building. But when I drilled into the detail a lot more, I realized that I could actually squeeze in 4 2-beds. I could actually squeeze in 2 1-beds and 3 2-beds. So I've got 5 units out of a 4-unit space. I've shrunk down and made the 2 units as efficient as they can be based on technical housing standards. So that's a 61 meter squared size 2-bed, 3-person flat. And I've squeezed in 500 square foot 1-beds instead of the larger units, which will give us a greater pound per square foot rate. It's probably worth saying at this point that also sometimes you will have to factor in what's selling in the area. I wouldn't want in this particular scheme, and I probably could have designed it that way, I wouldn't want all 1-beds in this scheme, because actually this neck of the woods will be young professionals. There will be first-time buyers that want a second room for their home office. So throwing in all 1-beds isn't going to suit the area. And these are all the conversations that you're going to have to be having with the local sales agents. I just wanted to raise people's awareness of this. If you're doing a multi-unit scheme, whether it's 10 units or 30 units, obviously the larger number of units that you're doing, the bigger an impact playing around with your development mix is going to have, because you've got more scope to add that value and tweak things and make improvements. So yeah, hopefully that's useful for people.
This is a super simple one, and we've talked about it before, and that's just basically time tracking. So easiest solution to reduce busyness. Now, it's sometimes impossible not to be busy, and actually my New Year's resolution 2 years ago was to not use the word busy, but I do feel like I'm constantly busy, and I don't know whether that's just my personality or whatever it may be. But one of our team members had a review yesterday. And look, the role has got so much scope. There's a lot of firefighting. There's a lot of things that need doing, and it's a lot of noisy business jobs that need to be carried out. which we can acknowledge, but I think that you can always help anyone, whether that's business ownership or even staffing, to be able to manage time effectively, because the compounding value of losing time is so detrimental to productivity. And everyone has a productive hour or an unproductive hour, whatever that may be, and get distracted and think, God, we know what happened there and then. But incremental wins every day and incremental changes every day. But if you can't measure it, you can't improve it, and you can't go, actually, I spend probably way too much time doing X, Y, and Z. So that's why I think time tracking is an absolute imperative. The easiest way to do it is just to build a calendar. Then you know what's going on. Everyone else knows what's going on. It only takes 5 minutes to do a week, in my opinion, if you just sort of check it in on it every day. Plus, you're using it to organize yourself and prioritize tasks. If I have a free hour, I will fill it with things that might not actually be that urgent. I might go online and buy a set of ski socks or whatever it may be. But if you have set tasks that are really urgent, high value tasks within that time frame, hopefully it will enable you to manage that time better and ensure that you do get those high value tasks delivered on. So essentially, I'm spending a bit of time with this said employee to help her, make sure that, and we may go through the process, and she's super efficient, cool, but we haven't got anything to lose to take a look at it and see if there's one potential tip or value gain that they can get from that process to buy them more time, essentially.
Nice. I've just actually seen that one of the other things that I missed out on the budget thing is that they are talking about reforming cash ISAs. So at the moment, there's a 20k tax-free limit, and there's chat to reduce that down to 12, which is actually massive, 40% reduction in what you can put away, tuck away, tax-free. Interesting. Cool. If you have any business, you're going to need some form of accounting software that is easy to use, gives you all the insight and financial data that you need to grow your business, to analyze your business, balance sheets, profit and losses, cash flow forecasts, etc. And Xero is the best place to go for that, in my opinion. We use it in every single business. Our accountants use it. They love it. We love it. And for the next 6 months, you can get 90% off by clicking the link down below. So if you're not already on Xero to track all of your business's financials, then do so now. Cool. On to some Q&A. Josh Grant. I love getting a message on Spotify because it very rarely happens. So when it does happen, I get excited. And Josh says, hello lads, I'm looking for my next project at the moment and still fairly new to property. What software or strategies are you using to quickly assess, price and validate a deal? That's probably one for you.
Yeah, we use Searchland and Property Data, but there are other options. I would say if you're doing flips, HMOs or leasey type building structure, Property Filter is really good. We always use a spreadsheet. You will not get us off a spreadsheet when analyzing a deal. I know that Searchland or Land Insight actually have an embedded deal analyzer where you use their UI interface, but it's just not intuitive enough for us, and we always resort back to a spreadsheet. One advice I would always offer, Josh, and I think that I was actually at an event and I heard someone else say this, and I've been saying it for years, and all of my team started laughing. To find a deal, it's not about qualifying a deal that works. It's about quickly discounting others. So the top tip is make sure you build like a fag packet, or we call it a draft analyzer, that's very high level, but quickly analyzes the fundamentals to get you close enough to draw a decision very quickly. Because the value isn't spending 3 days on a spreadsheet trying to get a deal that doesn't work anyway to work, because it's all the deals that you missed out on while you're trying to get that one deal to work. It's about having a quick ready reckoner to then go through 30 deals in 3 days and go pound per square foot in, pound per square foot out, likely pound per square foot conversion or new build cost. Does it look like on paper it could work? No, move on. And that speed is really important. And for that speed, I don't use any software. I use an Excel sheet. I tell a lie. I often use pound per square foot if I'm in a region that I don't know off the top of my head. And I'll typically go on a blended rate. I know that that's inaccurate, but it's accurate enough for me to discount the deal or take it forward. And then when we sort of narrow those margins, every spreadsheet we do, we spend more time on it. So the first ready reckoner draft analyzer might be 5 minutes. If it passes that, it will then be 10 minutes on the big stacker. If that then passes, I then scrutinize the GDV values, the build values, look at any abnormals, look at any potential planning contentions that we might have assumed as a given but are not a given. And then you're basically taking this phase all the way through to spend more and more time on it until you commit to it.
Nice. Solid advice. Johnny boy, in response to our LinkedIn post around how we've structured our Colney Hatch Lane scheme, says, hang on, if I understood this correctly, you bought land with 25k exchange deposit down, borrowed 50% of the land value, which would have been higher than the purchase price as it now has planning. The build cost was financed by a JV partner and the seller lent you 250k for nothing. It was actually 350k for nothing. How on earth did you manage to get all those people to agree to give you that much money? Creative structures. I mean, Jack sort of discussed it already in this section. Understanding how things could operate, putting things out there to the various parties, and negotiating. Ultimately with the 25k down, that's something that we do very, very regularly. We rarely ever put down a 10% deposit on a property. Ultimately that money gets sat there within the solicitor's bank account until completion happens. And if we've got an exchange with delayed completion, which is what we did on this for 12 months, 18 months, what's the point of having £250,000 sitting in a bank account, someone not doing anything? 25k is enough to give commitment. It then allows us to spend that money that otherwise would have been sitting there on planning, on legal fees, on reports, on assessments, all that good stuff. The 50% land value is standard. A general senior debt lender will lend up to something like 65% of land value and then give all of the building costs to you in arrears as part of the development facility. And then the JV, the seller vendor finance. That's unusual. We managed to negotiate that, whereby I think that the owner wanted to spread some of the value that he was getting out of the sale of the property across some tax years. He lives over in a different country, and ultimately, that's part of the negotiation that you need to be looking at, and ways in which you can creatively structure the deals to benefit you and de-risk. Gareth Bodwin, do you carve up a house internally in a similar way most of the time for 6-bed HMOs, or utilize a systematic approach to this? I struggle to create 6 bedrooms in houses, even if they're 160 square meters. I mean, I guess it depends on the type of housing stock that you're dealing with. There'd be a lot of properties that you can just rinse and repeat cookie cutter layouts because it's the same housing type, 1920s, 1940s, style of London property, for example. They are very, very similar with some quirks. So I'd imagine there's some housing stock that you could just be systematic with and just go again and go again. But others that might need a bit more creativity because it's a different.
Yeah, I think in the high value areas that we operate in, you have to have a very bespoke approach per house. Plus, we're in quite a heritagey area. There's a lot of older buildings with new buildings blended in between it and converted buildings. So it's very difficult to form a systematic approach. More generally speaking, if you look at, for example, a lot of our houses, we like to push the kitchen living space towards the back of the property and make it open plan, so that it offers really nice rolling space into the garden, and also that enables us to get fire route protection for the 6 tenants or 6 bedrooms, 7 tenants through the middle of front of the property, also directly sitting under the loft. So our typical structure is 2-2-2, 2 on the ground, 2 on the mid level, and then 2 on the top floor. Obviously you need quite a large footprint for that. And we have got properties where we've got 3 on the ground floor and 3 upstairs, for an example, and no loft conversion. So it's very bespoke. I would have thought you should be able to get 160 meters squared. Gareth, I would love to see an example of a floor plan sent over to me on WhatsApp, whatever. So DM us, and then I'll have a look and sort of do a few scribbles and let you know what I would do.
Yeah, on a very, very high level, if you're looking at something that's 160 square meters, you probably want to take out 15% for circulation. So you're down to 136. Let's say for a kitchen, living space, and some shared facilities like cupboards and like a downstairs loo or something, you probably take off 30 square meters. So you're left with 106 square meters for the bedrooms. Divide that by 6, you've got 17.6 meters squared for a bedroom. That is a very, very large bedroom with an ensuite. So there shouldn't be any reason why you can't get 6 bedrooms out of a house that's 160 square meters. So like Jack says, if you want some insight and some what we would do with your particular case, then drop us an email to info@xpproperty.co.uk. Cool. One final question before we dart off. Do you have a favorite building type, size and build year for commercial to resi conversions in Class G? Yeah, I do, to be fair. It's tame. It's a 1980s solid cavity wall, red brick building with RC concrete slab floors with large void spaces in the roof. Very solid buildings, very easy to convert. Often already large spans internally, which helps your structural and fit out. Working with period properties, 1920s London terraces, the build costs on those are astronomically more than a 1980s sturdy, robust office block, which is already very, very easy to convert. So yeah, very simple answer. Yes, I do. 1980s. Office blocks.
My input is every deal works at the right price. So
yeah,
you could buy the most painful building in the world to convert, but if it's at the right price,
it works.
Let's go, baby.
Yeah. Nice. Cool. That's enough for this week. If you've enjoyed it, don't forget to rate us down below, subscribe, like, do all that good stuff. And one thing we would ask from you is to share it. Please share it, because that's the thing that actually I think drives the algorithm more. People are the algorithm seeing that you like it, that you're sharing it because it's so good. And throw it into some property WhatsApp groups that you're part of if you think they will get value from it as well, which I'm sure they would. So have a good weekend, everyone, and see you next week. Bye.